Hello everyone, and welcome to today's in-depth financial analysis segment. Today, we will be focusing on India, a nation that has been making waves on the global economic stage in recent years. On the surface, India appears to be thriving, with record-high stock markets, a booming consumer market, and stable interest rates. However, today we will be peeling back this veil of prosperity to examine 6 key challenges that lie beneath India's economy. These issues are like 6 ticking time bombs, poised to alter India's economic trajectory and potentially cause instability in global markets. First, let's examine the stark contrast between India's economic facade and its underlying reality. Over the past 2 years, anyone following India's economy will surely have noticed one phenomenon. Its stock market has been booming. Since 2023, the Sensex and Nifty indices have surged relentlessly, repeatedly, hitting record highs. Even the occasional pullback was short-lived, with gains quickly recovered. By the end of 2024, both indices had climbed by over 15% for the year, attracting the attention of global investors. In terms of consumer spending, shopping malls in major cities such as Delhi and Mumbai have been extremely busy during the holidays, rivaling the bustle of popular commercial districts in China. In Q3 of 2024, India's retail sales surged by 8.2% year-on-year. At first glance, consumer vitality seems to be booming. Regarding interest rates, the Reserve Bank of India has kept its policy rate at 6.5% since the second half of 2023, providing a stable funding environment for the market with no hikes or cuts. Automobile and motorcycle sales were particularly impressive. India's total vehicle sales reached 4.78 million units in 2024, marking a 7.3% year-on-year increase. Specifically, 3.82 million passenger vehicles and 960,000 commercial vehicles were sold. Even more impressive were the 20 million motorcycles sold, representing a 5.1% annual increase and solidifying India's position as the world's largest two-wheeler market. The high-end property market also thrived, with luxury home transactions in key cities such as Mumbai and Bengaluru rising by 12.5% in 2024, accompanied by an 8.7% increase in property prices. Wealthy buyers were snapping up properties as easily as buying groceries. Investors and Indian policymakers might therefore conclude that India's economy is booming and sailing smoothly. However, I must caution that this optimism could be misleading. Beneath the surface, India's economy has quietly hit the brakes and entered a phase of slowing growth. According to authoritative data released by India's Central Statistical Office in March 2025, India's real GDP grew by just 6.7% year-on-year in 2024. While this figure sounds decent, it represents a significant slowdown compared to the 8.9% growth rate in 2023. Examining quarterly data reveals an even clearer trend of fluctuating and declining growth. Q1 saw growth of 8.4%, which dropped to 6.5% in Q2 and plummeted to 5.6% in Q3. Although Q4 saw a rebound to 6.2%, the overall downward momentum is now unstoppable. In January 2026, the International Monetary Fund (IMF) stated that, due to India's better-than-expected Q3 growth, it planned to revise its GDP growth forecast for FY 2025-2026 upwards, previously projected at 6.6%. It is now expected to be higher. However, it's important to note that this upward revision is relative. The fundamental issue lies in India's lack of endogenous growth momentum. Why is that? Because India's apparent prosperity relies on 2 short-term drivers: government spending and foreign capital inflows rather than internal growth. In 2024, India's government fiscal spending increased by 10.2% year-on-year, with capital expenditure rising by 14.3%. Funds were primarily allocated to infrastructure projects such as road construction, railway development, and port expansion. However, the marginal benefits of such large-scale spending are diminishing. Put simply, spending 100 rupees that previously stimulated 20 rupees of economic growth now yields only 10 rupees. Relying on this to sustain high growth in the long term is fundamentally unrealistic. In terms of foreign investment, India's net foreign direct investment inflows totaled $42 billion in 2024, marking a 10.6% decline from the $47 billion recorded in 2023. Why is foreign capital reluctant to enter? On the one hand, global economic growth has slowed, tightening everyone's purse strings. On the other hand, India's domestic policy landscape is rife with uncertainty. New regulations emerge today and policies shift tomorrow, leaving foreign investors feeling insecure. Compounded by rising geopolitical risks, no one wants to invest in unstable territories. More critically, India's economic growth suffers from poor quality. The job market is imbalanced, with many either unemployed or in precarious, low-paid jobs. Income disparities are widening, with the rich getting richer and the poor getting poorer. Infrastructure is improving but lags far behind China's. These structural issues have accumulated over the years without resolution and are inevitably dragging down economic growth. A slowdown was only a matter of time. Let's take a closer look at the consumer market. The so-called bustling scene is actually a tale of two extremes. Mid to high-end consumption is booming, while mass-market consumption remains sluggish. In 2024, India's FMCG sales increased by just 3.2% year-on-year. Growth in the low to mid-tier market was less than 2%, while the high-end segment surged by 11.3%. The disparity is stark. The underlying reason for this is clear. Low-income groups' earnings have barely increased. Without disposable income, how can they consume? Data from the National Sample Survey Organization shows that in 2024, per capita disposable income in rural India increased by just 2.8% year-on-year, while inflation was 3.2%. After adjusting for inflation, real income barely increased. Urban areas fared slightly better, with per capita disposable income rising by 4.5%. But real growth was still only 1.3%. With no money in their pockets, people can only cut back on spending. Beyond essentials such as food and daily necessities, they avoid making purchases wherever possible. How could a mid to low-end consumer market be anything but sluggish? The same logic applies to car sales. Growth was concentrated in mid to high-end models, priced above 100,000 rupees, while sales of low-end models declined by 3.2%. What does this reveal? Only middle to high-income groups have the means to upgrade their consumption. For the vast majority of low to middle-income earners, buying an affordable car is a real challenge. More concerning still, many in this group are now living on borrowed money. India's consumer loan balance surged by 18.7% year-on-year in 2024. This debt-fueled consumption model is unsustainable. Once repayment becomes impossible, the risk of household debt eruption increases, which could deliver a significant blow to the economy. As for the stock market boom, it is largely artificial too. The Reserve Bank of India's prolonged low interest rate policy has flooded the market with excess liquidity. With nowhere else to go, this money has poured into equities, causing share prices to rise artificially. Furthermore, India's stock market is dominated by institutional and foreign investors, with retail investors holding a relatively small share. When institutional investors concentrate their buying on a few stocks, prices can easily be driven up. Such share price increases bear little correlation to the health of the real economy. In 2024, the share prices of some major Indian tech and financial firms surged by over 20%, while their revenue growth failed to keep pace. Their price-to-earnings ratios reached absurdly high levels, clearly signaling a valuation bubble. Furthermore, India's stock market suffers from extreme sector concentration. Financials, information technology, and energy collectively account for over 60% of market capitalization. When these three sectors rise, the entire market rises, and when they fall, the market follows suit. Other sectors simply lack the strength to carry the market. If global liquidity were to tighten or foreign capital were to withdraw en masse, India's stock market would inevitably face significant downward pressure. At that point, the apparent prosperity will disappear overnight. Moving beyond appearances, let's address the second core issue, soaring government debt that is proving difficult to reduce. According to trading economics data, India's government debt to GDP ratio reached 81.92% by the end of 2024, far exceeding the 65% average among emerging market nations. Although this is down from its historic peak of 89.24% in 2020, it remains stubbornly high. This debt encompasses both central and state government liabilities, with central debt accounting for 58.7% of GDP and state debt accounting for 22.5%, the latter being particularly problematic. In 2024, 10 Indian states had debt to GDP ratios exceeding 30%. States such as Punjab and Haryana surpassed 35%, far exceeding the 25% warning threshold. Some states struggled to service even maturing debts. Bihar, for example, only avoided a debt crisis in 2024 through emergency funding from the central government. Long-term projections show a slight improvement, with debt to GDP ratios expected to fall to 80% by the end of 2025 and 78% in 2026. Although these levels remain dangerously high, does the Indian government want to reduce this debt? Absolutely. The finance minister has long declared debt reduction a core priority. The problem? There's no money to do it. A look at the government's spending priorities explains why. Funds are allocated where they're most needed, or rather, spent on essential obligations, leaving no surplus for debt repayment. According to India's Ministry of Finance's 2024 fiscal report, salaries account for 28% of fixed government expenditure. Total salary disbursements reached 19.6 trillion rupees in 2024, marking a 7.8% increase from 2023. Why are they so high? Because India's civil service is enormous, with over 3 million federal employees and more than 15 million state government workers. Paying all these people puts immense fiscal pressure on the government. Next come pensions, consuming 15% of revenue and totaling 10.5 trillion rupees in 2024, a 9.2% annual increase. India's population is aging rapidly, with the proportion of people aged 60 and over reaching 10.5% and continuing to rise. Pension expenditure will inevitably grow, consuming an increasing share of fiscal resources in future. Interest payments on existing debt constitute another significant portion of the budget, accounting for 25%. In 2024, these amounted to 17.5 trillion rupees, an 8.5% year-on-year increase. A large debt burden leads to higher interest costs, which in turn lead to larger fiscal deficits. Large deficits necessitate further borrowing, creating a vicious cycle of debt growth, increased interest, expanded deficits, and new borrowing. Finally, subsidies and social welfare expenditure accounted for 15% of the budget, totaling 10.5 trillion rupees in 2024. This includes 4.2 trillion rupees for food subsidies, 2.8 trillion rupees for fertilizer subsidies, and 1.5 trillion rupees for fuel subsidies. These subsidies target low-income groups and are crucial for social stability. Who would dare cut them lightly? Any reduction would affect people's livelihoods and threaten social stability. Together, these four types of expenditure account for over 80% of the Indian government's fiscal revenue. India's total fiscal revenue in 2024 was 70 trillion rupees, comprising 58 trillion rupees in tax revenue and 12 trillion rupees in non-tax revenue. After deducting the 56.7 trillion rupees of these for fixed expenditures, only 13.3 trillion rupees remain. However, the government must still pay 8.2 trillion rupees in debt principal and interest that year. Subtracting this leaves just 5.1 trillion rupees for infrastructure, education, and healthcare. How can such a small amount meet the development needs of a nation of over 1 billion people? Thus, the Indian government now faces a dilemma. To reduce debt, it must cut spending. However, reducing fixed expenditure threatens social stability, while slashing capital expenditure would hinder economic growth. Some economists previously advised Prime Minister Modi to reduce capital spending, arguing that the government's substantial capital expenditure includes inefficient projects and that cuts would have minimal impact on the economy. However, this argument simply doesn't hold water. Over the past 3 years, Government capital expenditure has been the main driver of India's economic growth. It grew by 24.5% in 2022, 18.7% in 2023, and 14.3% in 2024. These funds were invested in infrastructure such as roads, railways, ports, and power. This not only improved India's infrastructure standards, but also stimulated the development of related industries such as cement, steel, and construction machinery, creating a large number of jobs. Indian government reports show that, from 2022 to 2024, a 10% increase in government capital expenditure boosted GDP growth by 1.2 percentage points, drove related industry output growth by 2.5 percentage points, and created 1.2 million jobs. A substantial cut in capital expenditure would halt infrastructure projects, shrink related industries, reduce job opportunities, and suppress consumption and investment, inevitably leading to a decline in GDP growth. For example, a 10% reduction in government capital expenditure in 2025 is expected to reduce GDP growth by 0.5 percentage points, decrease the output value of related industries by 3.2 trillion rupees, and eliminate 1 million jobs. This would have a doubly negative impact on India's economy, which is already grappling with slowing growth and mounting employment pressures. Thus, the Indian government is caught in a genuine catch-22 situation between reducing debt and achieving economic growth, with no viable short-term solution in sight. A further issue is the slow growth of fiscal revenue, which leaves insufficient funds to support economic development. If India's fiscal revenue could grow steadily, even with a larger debt burden, incremental income could be used to gradually repay debts, making the debt problem less intractable. However, the reality is that India's core fiscal revenue engine has lost momentum, with growth continuously decelerating. The most critical indicator is the Goods and Services Tax (GST), India's primary indirect tax and the most reliable real-time gauge of economic activity. According to data from the Central Board of Indirect Taxes and Customs, NET-GST collections reached 1.92 trillion rupees in April 2024. Marking a 15.5% year-on-year increase. In May, collections totaled 1.44 trillion rupees, representing a 6.9% year-on-year increase. For the full year, net GST collections totaled 20.8 trillion rupees, marking a 15.2% year-on-year increase. While this growth rate may seem reasonable, it represents a decline of 5.6 percentage points from the 20.8% growth recorded in 2023. Furthermore, this marks the second consecutive year of decline, suggesting a contraction in India's economic activity. Some may question whether this slowdown stems from weak tax performance across many states. However, the claim that nearly half of the states are stagnating or contracting is inaccurate. According to data from the Press Information Bureau in June 2024, only a few states and union territories, such as Goa, Lakshadweep, and Ladakh, experienced negative GST revenue growth in May 2024. Major consumer states such as Tamil Nadu, Kerala, and Madhya Pradesh maintained solid growth rates. Tamil Nadu grew by 9%, Kerala by 13%, and Madhya Pradesh by the same amount. Most states recorded positive growth, albeit at varying speeds. The states experiencing genuine growth stagnation are primarily those with single industry, economies that rely on traditional agriculture. These regions are vulnerable to natural disasters and fluctuations in agricultural commodity prices. Coupled with weak industrial foundations, this makes tax revenue growth exceptionally challenging. Growth in fiscal revenue is primarily driven by manufacturing and logistics hubs such as Gujarat, Maharashtra, and Karnataka. In 2024, GST revenue from these three states increased by 28.5%, 25.3%, and 22.7% year-on-year respectively. Collectively, they contributed 45.2% of the nation's total GST revenue, truly acting as the backbone of the system. Why did these hub states see such rapid tax growth? Primarily through import-related taxes and GST integrated settlement. India's total imports reached $680 billion in 2024, marking an 8.3% year-on-year increase, while import duties and excise tax revenue surged by 15.2%. Most of these taxes are concentrated in port cities and manufacturing bases, which widens the tax gap between states. At the same time, the GST integrated settlement mechanism enables these hub states to receive more tax refunds, indirectly boosting fiscal revenue. However, this growth model has a major flaw in that it relies too heavily on a few regions and fails to stimulate sustained growth in national fiscal revenue. Furthermore, in a healthy economy, consumption should be the primary driver of fiscal revenue growth. Yet India's consumption is no longer sufficient to sustain fiscal revenue. According to the Central Statistical Office, India's private final consumption expenditure as a percentage of GDP was 57.3% in 2024, down from 58.1% in 2023 and 59.2% in 2022. Weak consumption directly slows growth in service sectors such as retail, catering, and entertainment, which are key sources of GST revenue. Their decline inevitably impacts fiscal revenue. Furthermore, India's consumption structure is severely imbalanced. While mid to high-end spending is growing rapidly, the majority of the population consists of low to middle-income groups with limited purchasing power. Without expanding the overall consumer market, fiscal revenue growth loses its broadest foundation. For a government aiming to reduce debt and achieve sustainable development, slowing fiscal revenue growth poses a significant obstacle. Without effective measures to boost revenue, debt problems will intensify and economic growth will slow down. The fourth core issue is the volatility of the household savings rate, which undermines the foundation of economic growth. India's growth model has long relied heavily on domestic savings, with household savings providing the main source of funding for government borrowing, corporate investment, and bank lending. Over the past few decades, Indian households have maintained strong savings habits, accumulating substantial reserves that have provided ample capital for economic development. However, in recent years, the trend in the household savings rate has become more complex, exhibiting a pattern of fluctuating adjustments rather than the continuous, unilateral decline described in the original text. According to reports from the Reserve Bank of India and the State Bank of India, India's net financial savings as a percentage of GDP reached 5.3% in FY 2024, marking a slight rebound from 5.0% in FY 2023 and putting an end to the previous downward trend. By the first half of FY 2024-25, this ratio had further increased to 7.3%, approaching pre-pandemic levels. Why the rebound? Primarily due to reduced household debt and optimized investment structures. Bank deposits accounted for 4.2% of GDP in FY 2024, still below the 5.8% recorded in FY 2020 by market-based savings. Channels such as insurance and mutual funds experienced exceptional growth, reaching 3.1% of GDP in FY 2024, doubling from 1.5% in 2020. What does this indicate? Indian households are changing their savings habits, moving away from bank deposits towards more diverse investments. This reflects a diversification of savings rather than a decline in the willingness to save. Meanwhile, the Reserve Bank of India has tightened regulations on personal and gold loans, effectively curbing excessive borrowing and reducing household debt. In the first half of FY 2024-25, India's household debt-to-GDP ratio fell from 6.9% in FY 2023 to 4.7%. With less debt, naturally more money is available for savings, a key factor in the rebound of the savings rate. However, the fluctuations in the household savings rate are driven by deeper issues, such as structural imbalances in the job market and uneven income distribution. According to cyclical labor force survey data released by India's Central Bureau of Statistics in November 2025, India's overall unemployment rate in 2024 was 3.2%, which is slightly higher than the 3.1% recorded in 2023, but remains historically low. Breaking it down further, the urban unemployment rate was 5.0%, down slightly from 5.2% in 2023. while the rural rate increased slightly from 2.4% to 2.5%, while the overall unemployment rate appears low. The core issue is the extremely low female labor force participation rate. In 2024, India's female labor force participation rate was 40.3%, a decline of 1 percentage point from 41.3% in 2023. Rural areas experienced a particularly severe female labor outflow. When women do not work, household income decreases, directly impacting savings accumulation. Additionally, wage disparities are severe. India's manufacturing sector saw average nominal wages rise by 4.8% year-on-year in 2024. After adjusting for 3.2% inflation, real growth was 1.6%, which is not the negative growth mentioned in the original text. However, daily wages for rural agricultural laborers averaged just 350 rupees, approximately $4.20, with nominal growth of 3.2% year-on-year and virtually zero real growth. The inability of low-income groups to increase their earnings and save money remains the key constraint on raising the savings rate. The inability of low-income groups to increase their earnings and save money remains the key constraint on raising the savings rate. Employment and income issues directly lead to a sluggish mass consumer market, and weak consumption in turn dampens corporate willingness to invest, creating a localized vicious cycle. Evidence of this can be seen in the fact that, in 2024, sales of mid to low-end products in India's fast-moving consumer goods FMCG sector grew by only 1.8%, which is far below the 11.3% growth seen in high-end products. Nevertheless, as the household net savings rate recovers, the pool of funds available for domestic investment and lending is gradually expanding. India's corporate investment rate, the proportion of gross fixed capital formation to GDP, recovered to 31.2% in 2024, up from 29.7% in 2023, indicating a slight improvement in corporate expansion intentions. Nevertheless, we must remain vigilant about one risk. Household debt continues to rise. In FY 2024, Indian household debt reached 41% of GDP, which is slightly higher than the 37.9% recorded in FY 2023. Housing loans accounted for 30% of this total, while non-housing consumer loans are also gradually increasing. In the long term, if household debt continues to grow, any economic turbulence could trigger a debt crisis as citizens struggle to repay loans, which could deliver a significant blow to the economy. The fifth core issue is mounting geopolitical pressures and an increasingly complex external environment. These represent major external factors currently impacting India's economic development, particularly the trade protectionist policies of the Trump administration in the United States, which have significantly disrupted India's foreign economic cooperation. Following Trump's re-election as U.S. president in 2024, his governing style became more aggressive than during his first term, with a more pronounced tendency towards trade protectionism, using India's circumvention of Russian energy sanctions as a pretext. Trump imposed 2 rounds of tariff hikes on Indian exports to the U.S. in August 2024, with cumulative rates reaching 50%. These measures affected goods worth $48.2 billion, primarily Indian exports such as textiles, leather goods, and certain manufactured products. In reality, U.S.-India trade negotiations began as early as 2018 but yielded little progress. The core disagreement centered on 3 areas. Firstly, intellectual property protection. The U.S. demanded that India strengthen pharmaceutical patent safeguards, reduce compulsory licensing, and protect the interests of American pharmaceutical companies. Secondly, market access. The U.S. sought to open India's agricultural market, lower import tariffs on farm products, and allow American rice, wheat, and meat to enter India. Thirdly, industry subsidies. The U.S. demanded that India reduce subsidies for the steel and aluminum sectors in order to eliminate trade distortions. India's demands are equally clear. It is seeking the U.S. to reinstate its generalized system of preferences, GSP benefits, and to lower import tariffs on Indian textiles and electronics. India also opposes the U.S.'s high tariffs on Indian steel and aluminum products. With such vast differences between their respective demands and neither side willing to compromise, negotiations have remained deadlocked. According to data from the U.S. Commerce Department, the value of goods traded between the U.S. and India in 2024 was approximately $128.8 billion, with India exporting $87.3 billion worth of goods to the U.S. and enjoying a trade surplus of $45.8 billion. The U.S. has become a vital trading partner and source of dollar-denominated income for India. While India's exports to the U.S. were impacted during the initial tariff escalation, with exports in September falling 12% year-on-year, and the decline in October narrowing to 8.6%, India did not sit idly by. It swiftly implemented countermeasures, such as securing tariff exemptions for critical products like pharmaceuticals and electronics. This was combined with a 7.7% depreciation of the rupee, which partially offset the tariff impact. Remarkably, by November, India's exports to the U.S. had surged by 22.6%, defying the trend. For the full year, exports to the U.S. not only avoided a decline, but actually increased, demonstrating a degree of resilience in India's economy. Beyond trade, the Trump administration also pressured India on energy and geopolitical fronts. As one of the world's major importers of Russian oil, India purchased $12.7 billion worth of Russian oil in 2024, accounting for 18% of its total oil imports, down from 22.3% previously. Why the reduction? To mitigate the risk of U.S. sanctions, the U.S. threatened to impose steep tariffs on countries importing Russian oil. Although these measures were never fully implemented, they still caused India serious concern, prompting it to swiftly adjust its energy import mix by increasing oil purchases from the US and the Middle East. Furthermore, the Trump administration's radical foreign policies, such as ordering the arrest of Venezuelan President Maduro and threatening to annex Greenland, exacerbated global geopolitical instability, making India's external development environment increasingly uncertain. Facing as tariff shocks, India did not simply endure the consequences. It adopted two approaches to enhance export resilience. Firstly, it accelerated negotiations on free trade agreements with economies such as the UK and the EU in order to diversify export markets and avoid over-reliance on any single source. Secondly, the government provided financial assistance to enterprises affected by tariffs, increased subsidies for bank loans, and supported corporate transformation and upgrading to foster diversified industries. Of course, we must acknowledge that India's economic scale and export competitiveness fall short of China's. In 2024, India's GDP totaled $3.85 trillion, representing just 20.3% of China's. And its foreign exchange reserves were $620 billion, which is also below China's $3.9 trillion. However, India successfully mitigated tariff impacts through targeted industrial exemptions, currency rate adjustments, and diversified market strategies, achieving a commendable 19.4% year-on-year increase in goods exports for the full year of 2024. The sixth core issue is populist political constraints hindering the implementation of economic policies. Against the backdrop of slowing economic growth and imbalanced employment structures, populist politics in India has indeed imposed constraints on economic policy. What constitutes populist policy? Put simply, it refers to politicians providing welfare benefits to the public, such as subsidies, debt waivers, and low-interest loans, to win elections. While these measures may temporarily ease social tensions, they ultimately increase fiscal burdens and distort economic structures. However, some of the figures in the original text are exaggerated and require correction. Check agricultural loan waivers, for example, a popular tactic among several Indian states. Governments, given that agriculture accounts for over 60% of the population and holds significant electoral weight. According to India's Ministry of Finance, the total value of agricultural loan waivers introduced by state governments in 2024 was 2.8 trillion rupees, a 12% increase on the 2.5 trillion rupees introduced in 2023, covering 105 million farming households. This contradicts the figures in the original text. which state 3.2 trillion rupees and 120 million households. Two examples illustrate this. Maharashtra's agricultural loan waiver totaled 420 billion rupees in 2024, covering 20 million farming households, while Uttar Pradesh's waiver amounted to 350 billion rupees, covering 16 million households. Such policies do impact banks' asset quality. India's rural credit cooperatives recorded a non-performing loan ratio of 10.2% in 2024, which is slightly higher than the 9.8% recorded in 2023, but still well below the 12.8% cited in the original text. Although banks' appetite for lending has been somewhat dampened, no large-scale credit crunch has occurred and agricultural loans continue to be disbursed as normal. Regarding subsidy policies, India's total subsidy expenditure in 2024 was 10.5 trillion rupees, accounting for 15% of fiscal revenue, a figure that is accurate. This includes fertilizer subsidies totaling 2.8. These subsidies play a crucial role in safeguarding the livelihoods of low-income groups and stabilizing prices. However, inefficiencies persist, with some subsidy funds being misappropriated or intercepted and failing to reach those in genuine need. The Indian government is addressing this issue by using digital platforms to reduce the number of intermediaries, make subsidy disbursement more efficient, and ensure targeted delivery to low-income populations, which had a slight impact on profitability. Regarding government recruitment, central and state governments collectively hired 950,000 civil servants in 2024, a 15% increase on 2023. While this created jobs, it also expanded the civil service workforce, raising concerns about administrative efficiency. Concurrently, rising salary and pension expenditure has intensified fiscal pressures. Another major fiscal factor is the establishment of the new pay commission. India's Central Pay Commission is reconstituted every 10 years to adjust civil servant salaries and allowances. Preparatory work for the 8th Commission began in late 2024, with salary adjustments expected in 2025, with projected increases ranging from 18% to 22%. This would add around 1 trillion to the central government's annual salary expenditure. Combined with state government adjustments, the total national expenditure increase would be 2.2 trillion, equivalent to 3.1% of fiscal revenue in 2024. While this would constrain fiscal spending capacity, the impact would be less than the 3.6% mentioned in the original text. Finally, a policy contradiction persists. Between 2022 and the end of 2024, the Reserve Bank of India has cut interest rates, reducing the policy rate by 125 basis points from 7.75% to 6.5%. It has signaled further easing in order to lower financing costs for businesses and individuals, with the aim of stimulating consumption and investment. However, government-backed small savings schemes such as the Public Provident Fund (PPF) and National Savings Certificates (NSC) continue to offer high interest rates. In 2024, the PPF offered an annual rate of 7.1%, while the NSC provided 6.8%, significantly higher than the 5.5% to 6.0% offered on bank fixed deposits. These high-yield small savings schemes attract substantial household deposits, preventing banks from lowering their funding costs. Consequently, banks cannot pass on the benefits of rate cuts to businesses and individuals, which significantly diminishes the effectiveness of monetary policy stimulus. However, the rebound in household savings rates in the second half of 2024 has eased this constraint on monetary policy somewhat. Alright, that concludes our analysis of the 6 core challenges facing India's economy. In summary, beneath its surface prosperity, India's economy grapples with tangible issues: mounting debt, slowing fiscal revenue, volatile savings rates, geopolitical pressures, and populist constraints. Whether India can overcome its growth bottleneck depends on resolving these structural issues and implementing genuine reforms. Of course, we must also acknowledge India's strengths, such as its demographic dividend, vast market potential, and industrial resilience. However, It will require time and sustained effort to transform these advantages into genuine growth momentum. We will continue to monitor the future trajectory of India's economy. That concludes today's in-depth analysis. Thank you for listening. If you found this content valuable, please like and share it. See you next time.